Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is October 7th of 2022, new month, new quarter, but a whole lot of the same old stuff going on in the overall market. Lots of volatility, lots of uncertainty, lots of false narratives out there that are being pushed, and we're going to help everyone organize that this week. Monday and Tuesday, as we all saw, we saw a pretty violent short cover bear market rally. Again, yes, we are net short, but overall, we're fine with that. You're going to have that time and time again. Markets were very oversold going into the end of the quarter. And certainly when you go into the weekend, you don't necessarily want to go into the weekend long, that's for sure. During a bear market, you are exposing yourself to event risk. And so overall, we worked off that overbought condition from Monday and Tuesday. And immediately Thursday and Friday, we saw the refutation of the whole Fed pivoting. So before we get into this whole presentation, if we can all commit ourselves to saying one thing, and that is, fool me once, fool me twice, fool me three times, we're not going to get caught with this whole false narrative that the Fed is pivoting before inflation comes under control. Because that's what happens. You go long on Wednesday, and then you immediately lose money Thursday and Friday. So we want to play defense. Nothing has changed, and that's going to be a big part of our presentation this week. So let's go ahead and get started. Quite simply, the Fed wants you to lose money. Their mission is not accomplished if you're making a whole ton of money out there in the market, and you're going out and using those profits to buy more things and push prices higher. Their job right now, as they see it, is to break the economy. Now, it's their fault that we're here to begin with. We shouldn't lose sight of that. But that's not what we're here to discuss. We're here to discuss what does it mean for your money? What does it mean for stock prices? What does it mean for bond prices? And how do we protect ourselves? And how do we make money in this type of environment? Let's not try to second guess what the Fed is telling us. The actual quote from the Jackson Hole meeting was from Jerome Powell: we will bring some pain to households and businesses, right? Federal policy, interest rate policy, is going to bring pain to household and businesses. Now, you can go ahead and second guess that and decide 2 weeks later they're going to pivot and do a 180 because the market's down 5%. But we're not going to do that. We're going to take them for their word, because they have a history of breaking things when they let things run too hot, and we're going to play defense. And that's exactly what we're doing. And that's today's agenda, quite frankly, quite simply, is that listen to what Powell's saying. You don't have to agree with him. We disagree with a lot of what the Fed says. But we're going to listen to what they're saying, because they're the ones that carry the weapons. They're the ones that carry the tools that are going to impact asset prices. So we should not be thinking that the Fed is bluffing unless something breaks. Then they will turn, right? So how do we want to look at the overall framework as it relates to the market right now? We're in this very dangerous period of what we call the gap, right? Minding the gap. Now, that was a title of one of our presentations a few weeks ago, but it's an important concept. The Fed was asleep at the wheel for a very long time and let inflation run hot, right? This was the inflation cycle. Now, the very end of that inflation cycle, quite frankly, we got wrong. We mispriced how much that war would extend out the inflation cycle, and as a result, how aggressive the Fed would be, right? But we adjust and we get better. We learn from those mistakes, and we're certainly not going to get phase two of the bear market wrong. And so what happened? We had this inflation cycle that pushed prices and interest rates higher, okay? And so the Fed had to respond. They said inflation was transitory. Guess what? It wasn't transitory. It turned out not to be transitory. It turned out to be sticky. Wages were sticky. Home prices were sticky. Asset prices were sticky. So now that the Fed got this wrong, they have to come and break the economy. So we've gone from this inflation cycle, which we're probably near the tail end of, and we're going into the recession cycle. Now, in between, you're going to get these short gyrations in the market where the markets go up massively over 2 or 3 days. because people, investors, speculators are going to say, well, the Fed's pivoting. That's good news. They're going to bring rates down. They're going to do QE. They're going to print money, and stock prices are going back to the moon. The Fed is only going to respond once they've broken something. And the reality is you don't want to be in the market when they break something. So there's going to be this lag. And in particular right now, the Fed is going after inflation. And inflation's at 8.2%. 8.2, 8.3, whatever the number is, doesn't matter. We're over 8% of inflation. The Fed can only respond to a weakening economy, which is the recession cycle, once this cycle is under control. So they want that to 2. So to go from 8.2 to 2 is a super long path. But the recession has already started to show itself in the US. We know that things are slowing down in the data. So the economy is weakening, but the Federal Reserve can't come in as they typically have done and cut rates or print money to support asset prices because this part, inflation, is still high. So in other words, asset prices are going to, if asset prices fall, if stock prices continue to fall, you're not going to have that typical aggressive Federal Reserve response to alleviate the selling. And that's really where the risk is. It's only once inflation is under control that the Fed can come in and really respond. So we got this Fed pivot narrative that took over this week, right? So we closed out the quarter. Market was terrible on Friday of last week. So Friday 2 weeks ago, I guess. The last day of the quarter, the last day of the month, the market was terrible. So what happened on Monday? We got this short cover rally that was followed through by another rally on Tuesday. What changed? What changed versus 2 days prior on Friday? Did inflation approach 2%? Did employment and growth suddenly collapse, forcing the Fed to respond by cutting rates and pivoting and undoing everything they just committed to do through Jerome Powell and a gazillion other Federal Reserve speakers that said they're not going to pivot and they're going to raise rates and they're going to break the economy? What changed in 2 days? The truth is nothing changed. It's just the market was oversold. But what would cause a pivot? What would cause the Federal Reserve to pivot? The one thing that could cause the Federal Reserve to pivot is that something systemic breaks. Now, we all saw those rumors over the last week that Credit Suisse was about to go under. And if you look at their credit default swaps, something is not looking right there. But something's not looking right systemically with the British gilt market either. Something systemically, it doesn't smell right in the Treasury market either. There's a lot of symptoms out there. Oh, and by the way, we haven't solved the whole Ukrainian war thing either, right? What happens when you back Putin into a corner? Again, we're not making a call. We're just saying there's a lot of symptoms out there that are emblematic of a market that's not well. And I think that's important. It's important to pay attention to those things when we're looking at asset allocation, when we're looking at how to protect the portfolios, and how whether or not to put clients' money at risk on the short side, long side, or stay neutral. But something will systemically break that causes the Fed to pivot. Here's the catch. The path between now and when something breaks is a very painful path. You don't want to take that path just so that you can be on the other side when they cut rates down to zero and then the asset prices go higher. You may lose 40, 50, 60% of your money between now and then. Again, not saying it will happen. I'm saying that can happen. And that's why we want to play defense. And then, of course, earnings shrink during recessions. One of the big things that we read out there right now is, oh, well, S&P is trading at 16 times. It's cheap. It's a bargain. Go and buy stocks 13 times. Here's the problem. It's assuming that earnings are going to grow in 2023. What do we know about recessions? We know that earnings contract during recessions. In fact, if you look at prior recessions, the average earnings contraction over the last 10 recessions is about 30%. In other words, earnings shrink 30%. If you strip out 2008 and the dot-com bubble, which were highly impactful events, outlier events, earnings still shrink 18.7%. And by the way, I don't know why you would want to strip out 2008 and 2000, because this is an even bigger bubble right now. But let's go with 18.7%. What would that do to the earnings multiple for the S&P 500? It would take it to 20.5 times. And I can tell you that that's not a cheap valuation for the S&P 500. In other words, we can still go to 14, 13, 15 times. You put a number, you decide. That means a market that's far lower from where it is today. So we have to pay attention to that kind of stuff. And we can see that when you adjust the price to sales multiple of the S&P 500, right? So you normalize the margins that businesses would typically operate under. The price to sales multiple is only back to where we were at the peak of 2000. And that was a really bad market as well. Multiples got wide because interest rates were at 0%, and we had quantitative easing and money printing. When you remove that, you get valuation compression back to more normalized levels. And we're already seeing it with corporate pre-announcements. AMD, FedEx, Carnival Cruise, Eastman Chemical. They're all saying the same things. Consumer demand is falling down. You got a cloudy macro environment. It clouds their forecast, longer lead times, high inventories. All these pre-announcements are consistent. We saw AMD was down something like 13, 14% today. One of the highest quality semiconductor companies out there. But does that sound like 7% annualized earnings growth to you when you look at where Wall Street is for 2023? That's what makes us bearish on the earnings front, where we think earnings estimates have to come down significantly. And then, oh, by the way, on that pivot, on the whole idea that the Fed's going to pivot because inflation is going to collapse, has anyone gone and filled their gas tank here in the last couple of weeks? Oil is back to $93, $94 a barrel. It's our biggest long position in the portfolio. So when you think about that, rising oil price is going to challenge the Fed's goal on inflation. So we're seeing a really, really bullish environment for oil. It's the only sector, when we look at the sector matrix, that has strong trend long-term and strong short-term momentum from a technical perspective. That's not good for inflation. Energy is the only sector in the market right now that's acting well, both long-term and short-term. And in the credit markets, stress is beginning to build. Again, hasn't broken, hasn't cracked, hasn't exploded, but it's creaking. We see high yield spreads continue to widen out. So the bottom line is, don't be fooled by the 1 to 2 day bear market rally. The Fed is tightening into a slowdown, and we believe that is bad. It's as simple as that. Use stock market rallies as opportune moments to reduce risk. The Fed does not have the capabilities right now to come in and save the stock market, because if they do that, inflation is going right back to 9 or 10%. And then they'll have to really hike rates. Lastly, we believe it is hard for the Fed to save the economy right now. So be vigilant, be defensive. That's what we're doing. The back part of this week, we made most of that back in terms of that bear market rally we saw Monday and Tuesday. So we like how things are positioned. But again, if you have any questions or concerns, please feel free to reach out to us, 888-543-3776. And otherwise, have a fantastic weekend. Talk to you later.